Hello, everyone. Welcome back to Desi Return. In this week's episode, we are going to cover another crucial question for a lot of families moving back to India. Should you sell your property or hold it and rent it before moving to India? For a lot of people, primary home is one of the biggest asset in their portfolio. Making a right choice is an important decision. It goes beyond numbers such as your long term plans, immigration status, risk appetite. In this video, we will dive into these different factors that can help you in deciding the best option for your situation. And I would be providing my recommendation on how one should think about it towards the end of the video. Let's dive in. The first factor, intent. What is your main intent to hold the property? Is it from a financial perspective, especially property appreciation, cash flow, diversification, or is it more to have a house if things doesn't work out when you move back to India as a safety net? If you want to be back in abroad, you have a house where you can come back and restart the life. Or you want to have a property for your future long-term plans where you're spending time between India and abroad, or if your kids are moving abroad for their education and for other reasons. This intent plays a key role in terms of which direction would be better in your particular situation. Second, it's the immigration status. If you are not a permanent resident or a citizen of the country where the property is located, you have to consider these four different aspects within this particular category. First, managing a property as a non-resident is quite challenging. Not having the flexibility to travel when you want, and you have to rely on the information from your property manager, friends, and family to make a decision on one of the biggest investment in your portfolio. Sometimes it's important to see and get things in the right place when you're selling or making the right decision. So please consider that flexibility or the challenging that a non-resident might have and have to rely on the information from friends and family or a property manager. Second, estate tax. Especially in US, if you are a non-resident and if you have assets more than 60,000, including the savings, 401k, everything, if it is more than 60,000 and if you pass away, there is something called an estate tax and it can go up to 40%. This is an important consideration to keep in mind when holding a property abroad. Third, the importance of tax filing. If you have a rental income, you have to file taxes in abroad. And also, it could be a complicated as you have to declare that in India when you become a resident and you have to file taxes. So it gets complicated. And fourth, withholding. So with withholding, there is, especially in US, there is something called Foreign Investment Real Property Tax Act, where when a non-resident is selling the property, the buyer of the property has to withhold 15% of the gross sales of the home, and it has to be given to IRS. You can get the money back after filing the taxes. However, keep in mind, even if you are not making profit from the property, or even if you're losing money, this money has to be withheld at the time of the sale, and you would get that back after filing the taxes. So please consider all these different factors in this category and make a decision which is much more appropriate for your particular circumstance. Now let's talk about the numbers. Have you considered all the factors when you're doing the calculation in terms of the cash flow or whether the rental yield is sufficient to compensate for all your expenses? Some of the factors that you need to consider is vacancy. Typically, you need to factor in 5 to 10%. If the house is vacant, it takes about a month or two before it can be rented out because you have to get it ready, market it, and then get the new tenants in. The other factors to consider are the property tax, insurance that can go up, capital X, capex items such as HVAC, roof, big plumbing thing. This is in addition to what you have already factored in for your repair and maintenance. This might not be something that you have to spend every year, but as the property gets older, this is some big ticket item that can hit your financials. So consider all these factors as well as turnover cost. When a tenant moves out, you have to clean the carpet, replace the carpet, or change the flooring, change the paint. Consider all these factors when you're doing the evaluation of your cash flow. Typically in US, there is this 1% rule for an investing in rental properties. This 1% rule is, let's say your value of the property is 300,000. The rental value, the monthly rental income for that house needs to be $3,000 for it to be cash flowing, and it's much more on an investment side. If not, you're betting on the property appreciation to compensate for the rental yield. The second factor, typically the capital gains. Typically, a lot of countries have capital gain exemption for your primary home. If you consider US, if you have been living in your primary home for 2 years, you would be qualified for capital gain tax exemption. And it is $500,000 if you are a married couple filing jointly. However, if you moved out of that house and it becomes an investment property, and if you haven't lived there 2 out of last 5 years, you won't qualify for this. As you can imagine, this 500 tax exemption at 10% or 15% is a big chunk of money that you need to factor in your overall financial number calculations. So take these into consideration and make a decision from a financial perspective if the numbers are still making sense. The fourth factor, which is your experience and risk appetite. Have you ever managed a property out of state, or you had a property away from where you're living and you're able to manage it with a property manager? It is much more challenging. Even with property manager, they can take you for a ride. They might not be doing things in your vested interest. It could be more from their ease of doing business. They might bring some vendors who might not be cost effective to get the job done. Second, the laws where the property is located. The laws change by county, state, and so on. Is that a landlord friendly or a tenant friendly? If it's not a landlord friendly, it becomes very, very challenging if you have a non-paying tenant in terms of filing eviction, getting them evicted from the property. It's a long process, lot of money, lot of headache that you have to go through. And then your risk appetite. As a person, can you sleep well if you have to pay out of pocket, if the property is vacant, or if there is a big expense that you have to pay? Or is that additional risk from your own personal lifestyle? Is that something that you want to take on? So when you take a step back and look at all these factors and see which one is the right choice for you based on your circumstances. And here is my personal recommendation. My personal recommendation is, if you have a long-term plans to utilize the house abroad, or you are a savvy investor where you have managed properties out of state and you have been investing in investment properties, it makes sense to hold the property and not sell it. Else, it might make sense to sell the property to avoid the hassle, to avoid the complications from the tax filing, managing it even with the property manager, and take the chunk of the money and invest in a real estate in India, or invest in stocks or real estate ETFs so that you have still an exposure and it is a liquid asset that you can manage from abroad. It is much harder to manage a illiquid or immovable property from a different country unless you are a savvy investor. I hope this video is helpful to guide you with different factors that you can consider to make the right decision for one of the biggest asset in your portfolio. If you have any questions or comments, please provide your feedback in the comment section below. Thanks and see you next week.